Chipotle Mexican Grill has been one of the best stocks that you could have owned over the past 15 or so years. It has crushed the market. It has made a lot of investors a lot of money. It also happens to be my favorite fast casual restaurant. I'm Jason Hall. This is Investing Unscripted. And we're going to talk about a couple of metrics. One that says Chipotle looks like maybe it's a buy, one that says not so fast. Before we get into the details, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you need to check out our special link. You see it right there on the screen. Go to fool.com/unscripted. Again, fool.com/unscripted. Check out that link and you can get access to the Motley Fool's 10 best stocks to buy right now. Check that out. It can help supercharge your investing. Okay, let's get to it. This is Chipotle stock's return since the company IPO'd, 5,550% in total returns. It's basically 10 bagged the market and generated 56-fold returns for investors. It's incredible what Chipotle has done. Now, more recently, I do want to point out, more recently, stock's down. It's down about 28% from its most recent high so far this year. And as you can see, historically, it does have a little bit of a record of pretty big sell-offs at different times. So a lot of people looking at that 27% sell-off and thinking, maybe this is an opportunity to buy Chipotle shares. Another thing that's happened recently that's definitely made it more interesting to a lot of investors is a stock split. They did a massive 50-for-1 stock split. This is a stock that was trading for more than $2,500 a share. Now it's trading for about $50 a share. That certainly makes it feel a lot more accessible for a lot of investors, easier to do things like trade options on it. $50 a share feels a lot cheaper and a lot more attractive than $2,500 a share. Now that's already happened. That went into effect about a month ago. See on the press release here, this happened back on June 26th. I'm recording this on July 25th, so we're almost exactly a month ago that this happened. For every one share of Chipotle you owned on June 18th, you got 49 more shares. So that's 50 for one. That's how that worked. So now let's talk about those metrics. Let's talk about what's happened. So Chipotle has always been a relatively expensive stock. And when I say expensive, I ain't talking about the stock price. It's pretty easy to think about a stock price and say, well, $2,500 stock is very expensive and a $1 stock is very cheap. So what you have to factor in is exactly what you're buying. And in a nutshell, it's the percentage of the company that you're going to own with each share that you buy and the value of that business itself. So for example, that dollar penny stock, there might be a billion shares outstanding. $2,500 stock, maybe there's only a few 100 million shares outstanding. And if the underlying business is worth a lot more for that expensive stock that's a lot fewer shares, you probably own a larger percentage of the business. And maybe more importantly, a percentage of the business's profits. That's what you really want to own when you buy a stock. You own a business, you want to own a percentage of the company's profits. So when you think about valuation versus stock price, it's a lot more important than the dollar figure behind the stock price. So we're going to talk about that. The two metrics that I'm going to talk about: price to earnings, price to operating cash flow. So you think about buying a business, and you want to think about owning a portion of its earnings, its future earnings too, not just earnings today, but its earnings potential over the long term, its ability to grow those earnings per share over the long term, but also, just as importantly, cash flow, because there's a lot of ways that earnings can kind of be manipulated a little bit, and it's not a cash number. Cash flow, operating cash flow, and then free cash flow are really useful because, well, that's cash. That's what companies use to pay all their bills, pay their employees. Now, they do pay stock sometimes too, but generally people want a paycheck. Vendors want money for the ingredients. Their landlords on the property, they want cash to cover those leases. All of those things take cash. So cash flow is really, really useful as well. I'm going to talk about some metrics in just a minute. But before we get to them, I do want to highlight, company just reported earnings, just released its earnings on July 24th after the market closed. So let's take a quick look at how the business is doing. You have to start there. You want to make money investing, buy high quality companies. We'll talk about the valuation, paying a reasonable price. Buy companies that are growing their earnings and have some ability to continue growing it over the long term. Here's Chipotle's second quarter results that they just reported. A couple of great things that they reported. You see revenue was up 18.2%, hit the $3 billion mark. Two ways that a company, like a restaurant, for example, for Chipotle, there's two ways that they can grow their revenues. Number one, they have to sell more stuff. but there's two ways you can generate more revenue. Number one, you can open more locations, grow your base, find new locations where you don't have a lot of locations already, sell to more people, get more revenue that way. You can also increase the amount of sales that you're generating from your existing locations. You can do that from one of two ways. You can raise prices, and you can also do things to increase traffic, right? So those are the different ways that a company like Chipotle can grow its business. So revenue is up 18.2%. We're going to start with getting more revenue out of their existing businesses. That's comparable restaurant sales. Sometimes you hear the word comps thrown out. That was up 11%. That means that revenue from existing locations that have been open for at least a year, so you're comparing the results from last year's base of restaurants, was up 11%. That's really, really good. Now, they highlight this up here to break that out. Now, that was 8% transaction growth. Okay, so that 11% comps growth, 8% transaction growth. What does that mean? That means that they had 8% more transactions happen. That's more people coming in to buy Chipotle, or some customers coming in more often to buy Chipotle. And they also said they saw margins expanded. So they got higher prices as well. So 8% in transaction growth, 3% growth in higher prices, better margins. That's really, really good. So as a result, margins got better. Operating margin almost 20%, 19.7%, up from 17.2%. That's really good, because if you start getting better operating margin, your operating income goes up. It's operating leverage. It's so, so powerful. Now, at the restaurant level, because now this operating margin, this includes all the costs to operate the corporate business as well. At the restaurant level, 28.9% operating margin. That is incredibly high. And they increased it from like 27.5% year over year. So that's really big growth. When you see these numbers increasing higher than revenue growth, that means you're getting operating leverage, which means as the scale of the business gets bigger, it pushes profits and makes it even more profitable. So I'm super pleased and impressed with seeing that. And then you bring it down to the earnings level, 32% increase in earnings per share. Gotta love it. Super strong results. Again, not just the comps growth, opened 52 new locations in the quarter. 46% include the drive-through, the Chipotle lane as they call it. So solid overall financial results from Chipotle, the business. Now, Chipotle also gives us some outlook as well. So this is what they're expecting for the full year. So they're saying comps to grow in the mid to high single digit range. Again, we got 11% in this quarter. So that was better than their full year guidance. So the expectation is maybe we're going to see some moderation in comps growth. But again, any restaurant that's growing comps at mid to high single digits is going to be super duper happy, especially if transaction growth is driving a lot of that, because you're getting more customers coming into your restaurant. They're also continuing to expand. They're saying they're going to open at the midpoint of guidance 300 new restaurants, and the vast majority are going to have that drive-through Chipotle lane. That's really good. So again, they're saying, you know what, we're basically expecting to continue to see solid overall growth. So you put all those things together, you got a very profitable business that its profits are growing, its cash flow is growing faster than its revenue growth. It's like all the things are working that you would want to see work. Now, so we have the good business part. We know that. That's definitely there. Now let's talk about the metrics, the valuation to decide, is Chipotle a buy right now? Or is it maybe still a little bit on the expensive side and investors maybe shouldn't rush out to back up the truck? So we're back to that chart where we're looking at the stock price. It's about 27% off of the high. But again, it's been such a really big winner over the long term. Let's think about valuation and not just stock price. I'm going to use a couple of metrics here. First thing I'm going to do is I'm going to pull up price to earnings ratio. So you see, right now it's about 49 times. That's not cheap. Well, it's never really been cheap for Chipotle. Over the long term, since its IPO, we're looking at a PE ratio average of about 65 times. Now, it's important to note that here recently, we've had some pretty big spikes in the PE ratio where their earnings were getting squeezed and the stock price still kind of stayed up. During the pandemic, early days of the pandemic, they had to add a lot of cost to deal with trying to serve customers during the pandemic. Sales were down initially when so many businesses had to close. So that pushed their PE ratio really high. And then back here, this was when they had the foodborne illness issues and they had to add a lot of cost to get better supply chain things implemented to make sure they could keep their food safe and make sure they could reassure customers. They also saw some big revenue declines right here when customers pulled away. They didn't want to go eat somewhere that they might actually get sick. It was a big thing that really upended the company. So the point is that these big spikes in the PE ratio right here push that average up. I also want to note that really the PE ratio in more recent years has increased. Not thinking about the average, but just the PE ratio versus where it was back in the 2010s, 20 teens. So I think that's important to note too that, yeah, sure, at 49 times, it is certainly cheaper than the average. And it is certainly cheaper than it's been for the early part of the 2020s. That's a positive, right? You think about that being a positive. But I want to take a look at cash flows too, because I want to balance this out a little bit. And 37 times operating cash flow is where we are right now. It's been closer to about 29 times on the average, and a lot of the period again in the 20 teens was below that. So put it all together, and what does that tell you? It tells me that Chipotle, even with this 27% ish sell off that we've seen, and with some of these metrics maybe trading a little bit below their recent averages, this is not a back up the truck kind of situation. The stock is not super duper cheap. Does that mean investors should stay away from Chipotle? No, I think it's probably still a buy at this point. There's still a lot of growth. They're executing on a great strategy. Since Brian Nickel came in as CEO a number of years ago, he has really turned the business around, and they have been an excellent, excellent operator. They're great at marketing their product. They're great at innovating with foods that customers love and come back to buy more of. So I don't think this is one that you want to avoid right now. This is probably a good stock to dollar cost average into over time. Maybe now's a good time to start a position, maybe add a little bit, but I don't think this is a back up the truck moment with Chipotle.